This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Daniel O'Brien, K-State grain economist, and Guy Allen, the senior economist at the IGP Institute, begin the show as they discuss the overall market reaction to the USDA reports, as well as feed grains. Keeping the show and their conversation rolling are Daniel and Guy as they continue chatting about wheat and soybeans, as well as also touching on transportation, foreign exchange, and government payments. K-State meteorologist Chip Redmond concludes today's show as he notes how current conditions in Kansas should have people paying extra attention to fire concerns. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show with the grain market update from K-State grain economist Daniel O'Brien and the senior economist at the IGP Institute at K-State, Guy Allen. Daniel, Guy, thank you both so much for taking the time to join us today.
Thank you very much, Shelby.
We recently got some USDA reports on Monday, January 12th, and wanting to take a 30,000-foot view of the grain market. And Daniel, what are we seeing?
Well, I think this market outcome or this set of information out of the USDA sets the tone for the feed grain market anyway, and probably impacts the other markets from now until we get more information out into the spring. Of course, there's the possibility of crop problems emerging someplace, particularly in South America, given that they're such a primary competitor of ours here in the U.S. for export markets. So, we'll be watching Brazil and Argentina. But in terms of, I guess I would say in terms of U.S. domestic production information, the supply side of the balance sheet, the reports that came in, especially for corn, were for large crops, larger than had been expected. We'll talk about that in a second. But overall, we had an initial strong negative reaction, 20-some cents in the lead corn futures contract. But since then, really the futures have been sideways to, with the kind of up and down movement. Here yesterday, up 9-10% for soybeans, et cetera. So I guess we'll look back on the charts after this report is done in about 2 or 3 months, and we'll see whether it was a one-time drop in prices that happened in the corn market, or it just took it to a lower level, and then we just kind of recalibrated and moved forward in whatever manner. Guy, what do you think?
Yeah, it's I guess the changes announced on Monday, it wasn't a surprise that they were larger, but they were just so much larger than the trade estimates had expected. And that's just, we had the biggest drop, single day drop there on Monday after the report than we've had for 5 or 6 years. I don't remember the time, but it's been quite a while since we've had that much movement. And that's sort of what the increase in numbers wasn't such a surprise as just the quantum of it. And I think you're right. We're sort of setting the tenor going forward. That said, we basically got cheap grain all over the world, and not just corn, but wheat and beans as well. And what's the encouraging side is, look, we're last year we had record corn exports, and we're on pace this year to have a new record export pace. So that they are buying American products. Wheat's been very, very good as well on the export pace, even though we've got a record world wheat production. And soybeans is what we like to cry about at the moment. But even without China in as they historically have been, export pace for soybeans thus far this year has not been bad.
And wanting to take a deeper dive into looking at just corn first, Daniel, what are we seeing domestically?
When you look at the specifics of the changes in the U.S. corn supply-demand balance sheet that came out on that January 12th report, there were changes, first of all, in the old crop 2024-25 marketing year. Again, and so again, that I guess for that period of time, you've got, of course, no change in crop size. That was settled a while back. So we didn't go back and look at our stocks previously and end up and make any changes in the previous 2024 numbers for the supply side. But by the time we had the stocks report come in, we had an adjustment downward for feed residual usage. The ethanol numbers left unchanged, a little bit lower amount for the wet corn milling number. We ended up with about 19, 20 million less bushels actually used in that marketing year by the time we pretty much closed things out for our consideration of it. Ending stocks were up about by the same amount. So we brought 19 million more stocks into that new crop into the current marketing year, the 25-26 marketing year. Again, started September 1st of 2025. And we ended up then and did see the production number come in at over 17 billion bushels, 17 billion, 21 million bushels. That was up 269, almost 270 million bushels from what we'd had before. And when you look at the pre-report expectations for the yield number, we had a range of 182 to 186 bushels per acre, and the number that came in was 186.5, over the top of that. So if as Guy and I both talked with farmer and industry groups, there was a lot of surprise, a lot of consternation for anybody that would be selling corn. And Guy, I think we can already make a prediction. You better believe when we get out to the September 2026 quarterly stock report, September 1st numbers, or the December 1st numbers, that if there's any major surprises where the USDA would come back and say, "Oh, I'm sorry, we overestimated it," there'll be a vocal reaction to that. Let's just say that. But in going on, total supplies again up to 18 billion 600,000 bushels. Hadn't been above 16.7 before, so breaking new ground on large supplies. The feed residual usage number was raised 100 million bushels. The ethanol number left unchanged, 100 million bushels to 6.2 billion. Ethanol is still at 5.6, just under the record high, I think, of where we'd been several years ago. The export number also left unchanged at 3.2 billion. I think the previous high is like 2.7 or 2.8. So, and again, we end up and see that as a result of U.S. corn shipments primarily to Mexico because of some cattle feeding issues that we have, insect infestations, all of that. Total use up 90 million bushels to 16.3 billion. Again, we were around 15 billion last year. So the one positive side of this, of having large supplies is that we give every incentive for corn usage industries to become all that much more well-established. Corn exports around the globe, particularly to Mexico, also well-established. So in a way, the best cure for low prices is low prices, because you encourage usage, and we're encouraging usage quite a bit. Then the ending stocks figure is over 2 billion to 2.2 billion. Stocks to use to up to 13.6%. The USDA did raise the price up to from $4 to $4.10. So interesting. Guy, what about the international side?
Well, looking at the world side of things, USDA world ending coarse grain stocks increased 12 million metric tons to 322 million, actually slightly smaller than last year. Of that change, that 12 million ton change, the U.S. accounted for 5 million tons of that increase, and China was 6.2 million tons of that increase. So with with that big number, corn was probably my most optimistic commodity that I thought was going to lead to any sort of price rally going forward into the spring, but those big numbers just sort of threw a bucket of water on that, and I'm not quite as optimistic. The other point on that is China's production increased 6.2 to 300 million metric tons, 6 million more than last year. I was surprised USDA left their imports unchanged at 8 million metric tons. I don't think we'll see China buy that much corn. And if you look at China's corn production, their acreage has gone up a little bit, but the real change we've seen in China is the adaptation of your GM crops about 5 years ago. They continue to increase their production, and I'd suggest in the next year or two, China will be self-sufficient in corn, if not even have a little bit of a exportable surplus. So they're just not going to be there. But that said, as I mentioned earlier, our U.S. corn exports were record last year, and we're on pace each month, setting record numbers again. So that's a very good sign that there's good demand out there. And I have to lend that to the whole animal feed, livestock sector provides good support there.
Wanting to move on then to grain sorghum, what do we see domestically there, Dan?
Not much change at all, really, in the supply-demand balance sheet. We saw the yield did drop about 2.4 bushels per acre, but you're dealing, instead of 90 million some acres, you're dealing with about 6. And so down to 72.6 bushels an acre stock. The actual production figure up 9 then, with changes in that balance sheet, changes in primarily in harvested acres, about 500,000 more than we thought we were going to have. It's all that up to 437 million bushels, 437 million bushels, and some other increases in the balance in that balance sheet. A little bit higher feed usage, a little bit higher ethanol usage by about 5 million per category. Really, the surprise in grain sorghum is that there's no change in the export number of 225 million bushels, and I think that's because China, in their negotiations with the United States, has promised to buy about 197 million bushels of grain sorghum. And then until that comes off the table and they say they're not going to do it, that 197, almost 200 million bushels makes up the bulk of the 225 that the USDA projects. So we'll see. I guess it's kind of a surprise. You have one crop, sorghum, with stocks to use figures going down based on that export assumption, down below 10%, price down to 370. So we'll see. Again, grain sorghum waits for the fulfillment of the export promises of other countries.
We're cutting to a short break now, but when we come back, we'll once again be joined by K-State's Daniel O'Brien and Guy Allen as we continue our grain market conversation. You're tuned back into Agriculture Today, and we continue our show and conversation with K-State grain economist Daniel O'Brien and the senior economist at the IGP Institute, Guy Allen. Picking up as we're talking about different commodities and wanting to start off our second segment with wheat. And Daniel, domestically, what are we seeing?
Pretty small changes. Interesting to see some of the trends in that. You look at the U.S. wheat supply demand balance sheet again. And for the 25-26 marketing year, that started June 1st. So we're a fair ways through that. No changes in acres. The production numbers unchanged, of course. Most of those reports came several years ago. A little bit of change in previous years, 24-25 year feed residual usage, et cetera. And the lowering of feed residual in the last marketing year kind of was a precursor to about a 20 million bushel drop in expected wheat feeding this year. And Guy, that probably comes from, gosh, we just have so many feed grains around. People are just staying the course on their corn and sorghum that they're feeding. So usage down about 21 million, total stocks, ending stocks up about 25. And really, if there's anything that surprises me in that whole deal, is that stocks use now for wheat in the United States is about 46% stocks to use. So for every 100 bushels of wheat that we use in the United States, we have 45 sitting in storage. It's not very price supportive. One other thing, we're in hard red winter wheat country. The USDA did drop the hard red winter wheat export figure or projection for this year down about 5 million to 320. But hard red winter wheat ending stocks to use as a class, 59%, down a little bit from 61, 62 last year. So we have a lot of wheat in storage. Guy, you and I have talked in the past about that. One of the big issues this year is the demand for storage, and the wheat situation just exacerbates that. How about the international side, Guy?
Well, much the same. International, look, we saw the USDA increase production by 4.4 million tons for this year. That's 442 million metric tons total, up 5%. And that's a new record this year. So the world is awash with wheat, and we're going to have, carryovers are going to be up a bit. The production numbers were pretty much unchanged. Argentina was up 3.5 million tons. The one comment there, if you put Australia and Argentina together, their exports were up 6 million metric tons. That's 16% compared to last year. So our friends in the Southern Hemisphere are giving us a bit of competition. But that said, as I mentioned earlier, the wheat exports out of the U.S. have not been too shabby this year, particularly when you put it in the context of world wheat production. A lot of that production was in the importing countries. Just one comment on China. They were up just modestly. USDA left their imports unchanged at 6 million metric tons. Again, I think that might be a bit overstated, but we'll sort of see how that plays out on that. So it's yeah, more of the same, and I'm surprised how strong our exports have been.
And our last commodity to chat about today that we usually talk about, soybeans. Daniel, what are we seeing domestically?
There was an increase in the amount of harvested acres for soybeans in the U.S. from 80,313 in the December report to the January report, 80,437, so about 120 million thereabouts. And that made some difference. Small increase in production. The balance sheet had a series of other little changes, but for right now, the USDA, the U.S. supply demand balance sheet, it's crush versus exports, and that's the mode that we're in right now. And the USDA did raise the crush figure by 15 million bushels up to 2.57 billion bushels, but lowered the export figure down by 60 million bushels down to 1.575. So, Guy, what you talked about before is pretty awfully important in terms of the seasonality when Brazil runs out and U.S. comes in. Just one other comment on supply demand balance sheet domestically. So again, we raised the ending stocks up to 350 million, up 60 from the December report, lowered the projected price by 30 cents from 10.50 down to 10.20. Stocks to use now instead of 6.7% up to 8.2. And for us, it behooves us to watch soybean oil, soybean meal. There's some positive things happening on the use side, some pretty decent export movement, et cetera. So, and we're out of the season where we're watching crop size into usage. So our attention for Guy and I will be turning quite a bit to what's happening on the meal and oil to see how much domestic crush we can move through our U.S. system and how much of it stays in the U.S. versus goes overseas from those co-products. Guy?
Yeah, just to expand on your domestic situation, the real surprise has been in soybean oil demand. We've seen that market continue to remain strong, even with soybean seed prices as well as meal prices continuing to fall. And I think a lot of that's coming out a bit of clarity now we're getting in the biofuels program, which is lending itself to a bit more certainty there and putting some demand in there for the soybean oil on that. Looking at the international markets, don't have necessarily a lot to add there. Ending stocks are up 2 million tons to 124. We're in a pretty comfortable positions. Chinese imports reflected at 112 million tons. I think that's a new record. Unfortunately, most of those are coming from our competitors in Brazil. But look, as you and I talked last summer, the fact that China came in just before Christmas, that was about the time the balance sheet that said that Brazil was going to run out. So not unexpected there, basically showing me your fundamental analysis will help you on timing and the overall price situation. Just expanding on China's domestic production, they had another record crop, which they've had. This will be the fourth year in a row where they've had a record soybean crop. Again, I think that's China's adaptation of some GMO traits in their production on that. So that's really what's been driving the soybeans.
And Guy, wanting to talk about something, the U.S. dollar and transportation. How are things looking?
Let's start with ocean freight. Ocean freight's just touched a 6-month low this week. China has had a record year on steel imports and exports, and that's a lot of what drives that dry bulk market is coal and iron ore and steel. That started to fade a bit. I think that's contributing a lot to the lower dry bulk freight rates. That's one thing that's contributing to, I think, our strong exports across all the commodities on that. So that's a good sign. Looking for a moment at the foreign exchange and the U.S. dollar. So when you sort of zoom back out and look at that dollar volatility really hasn't been that great, particularly since late 2021 through 22. We saw the dollar rally quite a bit, but we've come back down and traded between 110 and about 95 for the last few months. And we just haven't seen as much volatility, particularly when you're looking at the headline news on that situation. You would expect a bit more volatility there with all the excitement the news services put out there, but it's actually been a lot more stable than I think what we perceive on that. The other issue I'd sort of put up with the lower fuel price, I think that's on the transportation. I think we're going to see some lowering of transportation rates in the future, particularly as we approach July new crop wheat harvest on some of the rail rates. if our fuel prices continue to remain low for the next few months. Next point, just to mention that macro situation, I think we need to keep in mind the U.S. is scheduled to renegotiate the USMCA agreement with Canada and Mexico by July of this year. And I'm sure our bureaucrats in Washington and our U.S. trade representatives are busy sort of pushing those sort of issues with our neighbors to the north and south. And the outcome of that is going to be, I think, fairly significant. For agricultural products, that's sort of as one of my friends from Soybeans said this morning, it's sort of been the gold standard of the trade arrangement. And I can't help but think a lot of the rhetoric coming out of both Mexico and the U.S. and Canada is sort of positioning ourselves politically to all parties trying to get the best outcome for that renegotiated arrangement.
And Daniel, are there any other big macroeconomic topics that you think are important or you're keeping your eye on right now?
It's not directly a market activity, but does affect the actions of farmers, which affects their marketing. So we have government payments, around government payments projected to happen here shortly. And to the degree that helps to alleviates financial cash flow issues for farmers, it probably slows down cash sales. Again, so every farmer in Kansas has a default marketing plan, and that's to sell grain when they need cash. So if we don't need cash, there's some of the pressure's off. We can wait a little bit longer. And there may be other payments that come out in the fall too, being rumored. All that's still being discussed. So we'll see that if payments come, they'll help the financial position of farmers, and we'll see where all that goes. And I would say also, right now, January, February, early March, we're really not worried about weather in the United States having any impact on grain markets, but that changes once we get it March, early April, May, June, July. So I think absent some international surprise, you'd anticipate ceteris paribus, nothing else coming in, pretty storage-oriented level set of markets for a while. And we'll see if that expectation really finally plays out.
One thing related to payments there, Dan, we've sort of been waiting for the Supreme Court decision to come down on tariffs. And I think a lot of the administration's waiting to hear that. We were expecting a result on that a fortnight ago, but they haven't made an announcement one way or the other, or I think they may not even touch the subject and just not rule on that at the moment. But I think they're waiting for a bit of clarity on that because a lot of the revenue coming in from tariffs, I think, was expected to be utilized to make a number of these farm payments. So it's one thing that's sort of pushing that back a bit.
Daniel, Guy, I appreciate you both taking the time to join us today.
Thank you very much, Shelby.
That was a senior economist at the IGP Institute, Guy Allen, and K-State grain economist, Daniel O'Brien. We're cutting to a short break now, but stick around because we have more for you up ahead. Tuned in to Agriculture Today, and we conclude our Friday show with a weather update from K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Thanks for having me, Shelby.
Chip, last week we saw some precipitation in Kansas, and what were those amounts when we're looking at the rain and snow?
Yeah, we had some pretty impressive winter precipitation. We'll start with central eastern Kansas, where they had that rain event last week. We got anywhere from an inch as much as 2 inches in Kansas City and in the Olathe area, where the maximum totals. We get further west, precipitation tapered off a little bit, with as much as 3/4 of an inch to 0.8 of an inch or so for much of central and even some of the areas of west central. Needed rain. It had been about 30 to 40 days since a lot of folks had seen rain, and so that definitely helped fill the void of lack of moisture and the deficit we had built up over that time period. Then we had the second system come through in the early part of the weekend, and that focused mainly across southwest Kansas. And we were expecting some snow, but we definitely had a little bit of an overperformance, as much as 12 inches of snow in Hamilton, Stanton, Kearney County. We melted all that down over the course of the last several days. And we ended up with about a 1/2 inch of moisture from that raw snow that didn't thankfully blow, which is rare for western Kansas this time of year when we have a big snow event like that. So you have to kind of enjoy the pretty snow when we can get it. But I know travel was pretty challenging, and hopefully most people prepared for that snow event with the cattle and whatnot. But it was a little bit of an overperformance, and that makes things pretty challenging when I know from a preparation standpoint.
In southwest Kansas, as you mentioned, saw a lot of snow, but is any of it still there?
Yeah, so as I mentioned, there's really no snow left. It melted down to about a half inch, and the snow cover helped provide much colder temperatures over the weekend compared to the rest of the state, and really even early week. We had temperatures over that snowpack that were sitting about 20, 30 degrees cooler than the rest of the state. In fact, it got down in the single digits. It was the coldest location in the state there in Stanton County on the Kansas Mesonet, at least. When we look at as a whole, though, warmer temperatures won overall. It's all gone. It's into the soils, definitely added to some good soil moisture in the region and helped replenish some of that recent deficit.
What are we seeing then when it comes to the wind?
So wind's been minor for the most part over the course of the last week or so. We've had a couple of cold fronts come through with just some breezy conditions. The forecast, though, has a substantial increase in wind expected, especially on Friday. We're going to see gusts up to 50, 60 miles an hour. They're still in Colorado-Nebraska border, and that's going to yield some nasty driving conditions. And we look at the map, northwest Kansas missed out on a lot of that rainfall. Trying to line from Wallace County eastward to Trego County and then northward to Norton County. That northwest corner of the state missed that moisture, and so I'm really concerned we're going to get a lot of blowing dusts from that region. They're gone almost 60 days now without wetting precipitation, at least a tenth of an inch. We need it badly up there. But that's going to result in a lot of blowing dust. And then we're going to have really low humidity with this system as well, especially on Friday and then through Saturday and Sunday. That low humidity combined with breezy winds and strong winds at times is going to yield really, really elevated fire weather to critical fire weather. And any fire start is going to grow rapidly and potentially be a significant problem if it aligns with the fuels or grassy area. Obviously, some of the crops and wheat obviously won't burn, but wheat stubble and other crop stubble will burn. And it only takes an hour for things to dry out. We look at areas like the southwest Kansas that had the snow. That grass, if it didn't get matted down and still standing, it's going to dry out really quick. It can still dry out in about an hour with low humidity. And so it'll burn very efficiently. And you won't notice any impact of the snow, except for maybe the mud. So just be cognizant of sparks over the weekend, really for the whole state. And we need to just be aware of maybe if we have had any burns. I know folks are burning some piles of brush and that kind of thing. That stuff can hold heat for days on end. And so it's a good time to go through, make sure those piles are out, check them, double check them, triple check them, and make sure those aren't sources for fire starts this weekend when the winds pick up.
Chip, I appreciate you taking the time to join us today.
Yeah, thanks for having me.
That was K-State meteorologist Chip Redmond. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.